Welcome to Alpha Recap. Juniper here. We're coming to you after the close with a look at what shifted in the markets today. As always, if you have questions, you can reach us at stockalpha.ai.
Great to be here. The trading day wrapped up with a pretty clear theme, a rotation away from high multiple growth and small cap risk into more defensive and commodity-linked names.
Right. So, what really stands out here is how shallow the headline S&P move looked versus how much was happening underneath.
Exactly. The S&P 500 closed down about 0.1%, but the Nasdaq 100 finished down nearly 0.9%, and the small cap benchmark slipped about 1%. That gap told the story.
So we saw a modest broad market dip, a bigger pullback in mega cap tech, and small caps getting hit harder. What were the drivers?
There were a few cross-currents. Company earnings and guidance were in focus. Think of earnings headlines and previews from names like Pfizer, an athletic brand that beat, and another that showed softer trends. On top of that, structural flows tied to options hedging and ETFs played a role. Then sector headlines, renewables and grid investment, pushed utilities higher.
Options hedging. Okay, let's slow down on that. Can you explain gamma and dealer hedging in plain English?
Sure. When traders buy options, dealers who sell those options often hedge by buying or selling the underlying stock to stay neutral. Gamma measures how quickly those hedge amounts change as the stock moves. If there's a concentrated wall at a price level, dealers may be forced to buy or sell a lot as the stock approaches that level. And in thinly traded names, that can amplify moves. The conversation around Poet and the so-called $15 wall is a good example of how that dynamic can make a stock more volatile.
Right. And the other thing is flow-induced dislocations tend to hit small caps harder because liquidity is thinner.
Exactly. When dealers need to hedge in a small cap name, there's less depth, so price swings widen. That helped explain the nearly 1% slide in small caps today.
Let's walk sectors. Utilities were the day's standout. Why did that trade catch on?
Investors bid up regulated utilities and renewable-linked names on fresh thematic notes about grid investment. In a market that's questioning faster growth or earlier rate cuts, steady, long-dated cash flows looked attractive. People moved toward income and defensive revenue streams.
Materials and mining did well too, right?
Yes, base metals and precious metals miners saw momentum. Commodity-friendly narratives and partial risk-off positioning often lift gold and industrials. Some of it was real economy demand signals. Some of it was safe haven demand.
Real estate showed resilience as well.
Select real estate investment trusts attracted interest as yield-sensitive allocations rebalanced. Stable dividends and supply fundamentals in certain property types kept that group relatively steady even while small cap sentiment soured.
Technology, though, led the downside.
Yeah, that tracks. The tech complex bore the brunt. Profit-taking and tactical rebalancing hit high valuation names, many of which had been priced for later rate cut scenarios. When yields moved a bit and the dollar had intraday volatility, duration-sensitive tech took pressure.
Cisco's AI previews and Apple's post-quarter commentary were focal points for traders, correct?
Right. Commentary on AI infrastructure demand and post-quarter positioning made those names focal. But broadly, QQQ giving back gains reflected a broader reassessment of growth sensitivity.
Energy was patchy. Geopolitics and oil moves made it a mixed bag.
Yes, and EV supply chain headlines nudged sentiment within the group. Some battery and parts names were influenced by those micro headlines rather than broad oil moves.
Quick reactions. Honestly, I was a bit surprised by Pfizer's headline.
Yeah. Pfizer's reported drop in net income got attention and raised questions about dividend sustainability in some income-focused portfolios. Analysts are parsing one-time items versus core operations.
And on holding beat, while Nike was softer, showing consumer divergence.
Exactly. A clear bifurcation within consumer discretionary. One premium athletic shoe name beat expectations, while apparel showed a weaker tone. That split was a neat microcosm of the day's dispersion.
What about the banks and brokers you mentioned?
Fifth Third outperformed regional bank peers early on amid constructive comments about fundamentals and capital management. But the broader sector later pulled back. Charles Schwab was a focal point of debate about revenue trajectory and margins, which kept trading active in financials.
Let's talk macro and Fed implications for a moment.
Good call. There wasn't one dominant macro print, but market behavior was consistent with participants pricing a scenario where rate cuts might be delayed. Until inflation readings consistently undershoot expectations, the Fed can stay data-dependent, which supports a cautious posture in cyclical and small-cap exposures.
Put simply, higher nominal yields make long-duration growth names less attractive on a relative basis.
Right. Even small moves in yields can compress valuations for long-duration sectors, and that helps explain part of the tech pullback.
Crypto was quiet by comparison.
Yes, Bitcoin and major altcoins traded in a narrow range while equities digested the rotation.
Market breadth was negative today, which matters.
It does. More decliners than advancers. And the disparity between a small S&P drop and larger Nasdaq and small cap declines shows concentrated selling in growth and smaller names. Technical traders will be watching for lower high, lower low patterns in leadership sectors.
All right, quick checklist on what to watch next session.
Track incoming CPI and PPI prints and Fed speak. Watch bond yields and the dollar. Keep an eye on options expirations and gamma-driven flows, and follow earnings follow-ups from the names that reported today.
And sector flows. Utilities and materials could keep running if renewables and commodity narratives persist.
Yep. Conversely, a return to growth leadership would likely show stabilization in the tech-heavy benchmark.
Final takeaways, Josh?
First, today was a reminder that headline index moves can mask big internal rotation. Second, options and ETF flow dynamics continue to amplify episodic volatility, especially in thin names. Third, the market is paying close attention to inflation and Fed timing. That's shaping sector bets toward income and commodities for now. All of this is analysis for information only. It's not personalized investment advice.
Solid. Bottom line, markets closed with a modest S&P decline, but a clearer swing under the surface. Tech and small caps were trimmed while utilities, materials, and some REITs rallied. Keep an eye on macro prints, yields, and options flows.
Exactly. And remember, traders and longer-term allocators should monitor whether this rotation is transient or a broader leadership shift.
Thanks for joining me, Josh. And thanks to everyone listening.
My pleasure. Good to be here.
If you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai.
Thanks. And remember, this episode is informational only. Analysts note these market drivers, but this is not advice to buy, sell, or hold any security.